Do you know which retirement account you should absolutely never touch first? And why getting that order wrong can cost you a fortune in avoidable taxes? Hello, this is Daniel Robert Whitmore, and I'm so glad you're here. I've spent over 2 decades working inside the Social Security Administration, and now I dedicate my time to helping Americans like you navigate the retirement years with confidence and clarity. Today, I want to talk with you about something that can genuinely save you tens of thousands of dollars, or cost you that same amount, depending on how you approach it. When you leave your job, something profound changes. That regular paycheck that arrived every 2 weeks, the one that made all the bills manageable, simply stops. For some people, that realization hits like a wave. Suddenly, you're responsible for creating your own income. It's not the same as working. There's no employer, no direct deposit, just you and your portfolio looking at each other. Now, here's the thing I've learned from decades of conversations with soon-to-be retirees. Most people understand they'll have multiple income sources in retirement. They know Social Security is coming. They know they might have a pension or rental income from properties, or maybe an annuity they purchased years ago. But very few people truly grasp how critical it is to coordinate these sources strategically. And even fewer understand that where you withdraw your money from, quite literally which account you tap first, can be the difference between a comfortable retirement and one where you're constantly worried about taxes eating away at your nest egg. Let me walk you through my framework. I've used this with hundreds of clients, and it works because it's logical, and it's based on one simple principle. Managing your tax brackets is the real game in retirement. The first thing I always ask my clients is this: what money is absolutely guaranteed to arrive without you having to touch your investments? This is your foundation. For some people, it's a pension from 30 years with the same company. For others, it's Social Security, or maybe both. For some, it's rental income from a vacation home. For a few, it's an annuity payment they set up earlier in life. Whatever these sources are, this is your baseline income. This is the money that shows up regardless of market conditions, regardless of whether your portfolio is having a good year or a bad year. So let's say together, you and your spouse, if applicable, you have $8,000 coming in each month from guaranteed sources. That's $96,000 a year. That's your floor. That's what you know you're getting. Now, the second step is honest math. How much do you actually need to spend each year to live the retirement you envision? Not the retirement you think you should want, but the one you actually want. Is it $120,000 a year? $150,000? $200,000? Write it down. Be real about it. Once you know your goal and you know your guaranteed income, you've just calculated what I call your shortfall, the gap between what's guaranteed and what you need. If you need $120,000 and you're getting $96,000 guaranteed, your shortfall is $24,000. That $24,000 is what you need to pull from your investments. That's the number that matters. Now comes the part that most people get wrong, and it's where the real tax planning happens. You have 3 types of accounts. Most people know this in theory, but they don't know how to use it in practice. Your first account type is taxable. This might be a brokerage account. Maybe you opened it at your bank or with a brokerage firm. It could be in your name alone or jointly with your spouse. The key thing about taxable accounts is that you already paid income tax on the money when you earned it. Now, when that money sits there, if it earns dividends or interest, those get taxed each year. If you sell an investment at a profit, the gain gets taxed. But, and this is important, the basis, the amount you originally put in, is not taxed again. Your second account type is tax deferred. These are accounts like your traditional IRA, your 401k, your 403b, maybe a SEP IRA if you were self-employed. You contributed to these accounts with pre-tax dollars, meaning you got a deduction on your tax return at the time. The money grew inside the account without being taxed along the way. But here's the deal. When you take money out, it's fully taxable as ordinary income. Your third account type is tax-free. This includes Roth IRAs and Roth 401ks. You contributed to these with after-tax dollars. No deduction at the time. But everything that comes out of them, including all the growth, is completely tax-free. Forever. Now I'll tell you what most advisors recommend, and there's some wisdom in it. They say, start with your taxable accounts. Drain those first. Then move to your tax-deferred accounts. And preserve your Roth for as long as possible because all that growth is tax-free. There's logic to it. Why would you want to spend down money that grows tax-free when you could spend money that's already been taxed? The idea is to let that Roth compound forever. But, and this is a big but, this approach is actually backwards when it comes to minimizing your lifetime tax burden. Here's why. And I'm going to show you with a real example that I worked through with a client just last year. Mark and Susan came to me. They were both 62, both retiring at the same time. They had a pension together worth about $45,000 a year. They had Social Security that would total about $54,000 a year combined. That's $99,000 guaranteed. But they wanted to spend $140,000 a year. That meant they needed $41,000 from their portfolio each year. Now, their current taxable income, the income from the pension and Social Security, after working through the provisional income calculation, was about $68,000. They were safely in the 12% federal tax bracket for married filing jointly. But here's where their old advisor had told them to do. Pull $41,000 from your traditional IRA first. Why? Because the IRA was large, about $580,000. The taxable brokerage account was smaller, about $120,000. They wanted to defer taxing it. If they took $41,000 from the IRA, their new taxable income would jump to $109,000. That's crossing a huge boundary. They'd fill up the rest of the 12% bracket and jump almost $28,000 into the 22% bracket. Suddenly, instead of paying roughly $5,000 in federal taxes on the distribution, they'd pay nearly $9,000. But I showed them a different way. With their guaranteed income of $68,000, they still had about $12,000 of room left in the 12% bracket before hitting $80,000. Here's what we did. We took $12,000 from the IRA, which filled that bracket to exactly $80,000. Then we took the remaining $29,000 from their taxable brokerage account. Now, the taxable account is mostly basis. They had put in $100,000 of their own money, and it had grown to $120,000, so only $20,000 of that was gains. By withdrawing $29,000, they were pulling out mostly their own money, which wasn't taxable, plus some gains. The result? Federal taxes on the entire $41,000 withdrawal dropped to under $2,000. That's a difference of roughly $7,000 in a single year. Over a 5-year period before Mark had to start required minimum distributions at 73, that could be $35,000 in taxes they weren't paying. And that $7,000 savings? They just added years to their portfolio. That's the power of strategic withdrawal sequencing. Now, there are other considerations I want you to think about as you build your own strategy. First, let your Roth grow if you can. I'm not saying never touch it. I'm saying be intentional. If your Roth IRA is currently $150,000 and you let it sit for 15 years, it might be $300,000. That tax-free growth, that doubling of money with zero taxes, that's powerful. Don't squander it in the early years of retirement when you have other options. Second, be aware of RMDs, required minimum distributions. This is a rule I learned well at Social Security. Starting at age 73, the government requires you to withdraw a specific percentage of your traditional IRAs and tax-deferred accounts each year. If you have a very large IRA, these distributions can be substantial. And here's the trap many retirees fall into. They spend down their taxable account and their Roth in their early 60s and 70s, thinking they're being clever. Then they hit 73, 74, 75, and suddenly the RMD forces them to take a huge amount from their IRA. Now they're stuck. They don't have choices anymore. They're paying 22 or 24% on money they're forced to take. So sometimes, and this is contrary to what you might read, it actually makes sense to take more from your IRA in your early retirement years, when you can control the amount, to keep that IRA balance manageable. This way, your RMDs later won't force you into a high tax bracket. Third, understand Social Security taxation. Most people think their Social Security is not taxable. That's true for lower-income retirees. But once your provisional income reaches certain thresholds, up to 85% of your Social Security can become taxable. Your provisional income is roughly your adjusted gross income, plus tax-exempt interest, plus half your Social Security. So if you're pulling money from a traditional IRA, it increases your adjusted gross income, which can increase your provisional income, which can increase how much of your Social Security is taxed. It's a cascade effect. But if you're pulling from a Roth IRA or from taxable accounts where you're only recognizing gains, you don't trigger this cascade. See? It all connects. Fourth, there's something called IRMAA surcharges. These are income-related monthly adjustment amounts for Medicare. Once you reach a certain income threshold, currently $194,000 for married filing jointly, your Medicare Part B and Part D premiums start increasing. These surcharges are based on your modified adjusted gross income from 2 years prior. So your withdrawal decisions today affect what you'll pay for Medicare 2 years from now. Another reason to be strategic about which account you tap. Fifth, think about tax gain harvesting. If your income in a particular year is low enough, say you take only Roth or basis-heavy taxable withdrawals, you might have room in your tax bracket to actually realize some capital gains in your brokerage account at zero federal tax. Imagine selling appreciated stocks and owing nothing in federal tax. That's not only possible, that's smart. It's like getting free stock that's already appreciated. Sixth, there are Roth conversions. This is advanced, but I'll mention it because it's powerful. If you have a low-income year in early retirement, say you're living entirely on Roth withdrawals, you might take some money from your traditional IRA and convert it to a Roth, paying tax on it in that low year. You're paying tax in a 12% bracket instead of waiting until you're forced to take RMDs in a 22% bracket. Over decades, this saves significant money. The big insight, and I want you to really hear this, is this. Where you pull your money from in retirement is not primarily an investment decision. It's a tax decision. You're not changing your asset allocation. You're not changing what's invested where. You're not timing the market. You're simply choosing which bucket to drink from. But that choice reverberates through your taxes, through Medicare costs, through how much of your Social Security becomes taxable, through your ability to do tax loss harvesting, or Roth conversions, and ultimately through how many years your money lasts. Let me be clear about something. I'm not telling you to never touch your Roth or your tax-deferred accounts first. Context matters. If your taxable account has a lot of unrealized losses, maybe you want to harvest some of those against gains before selling. If you're in a low-income year and a conversion makes sense, do it. If your IRA is growing so large it scares you, taking more from it earlier might be the right move. What I'm telling you is this. Don't default to a generic rule. Don't pull from your largest account first. Don't pull exclusively from taxable first just because an article told you to. Make a decision based on your actual situation, your brackets, your sources of income, your health situation, your plans for required minimum distributions, your Medicare status. This is one of the most impactful decisions in retirement, and it's worth getting right. If you're within a few years of retirement, or if you're already retired and you've never thought through your withdrawal sequence strategically, I'd encourage you to sit down with a calculator or with a professional and run the numbers. Show me what happens if you take from account A versus account B. Let me see the tax impact. Let me see the cascade effect on Social Security. Let me see the Medicare surcharge implications. That analysis might be the best few $100s you spend, because the savings will compound for the next 30 years. I'm Daniel Whitmore, and I believe every American deserves to understand their retirement better. If this video resonated with you, I'd be honored if you'd like and subscribe. If you know someone nearing retirement who's making withdrawal decisions without this framework, please share it with them. You might just save them thousands of dollars. Until next time, stay secure in your retirement.